How does a leveraged buyout, LBO, work in mergers and acquisitions? Imagine a scenario where a financial sponsor or private equity firm aims to acquire a company using a combination of borrowed funds and their own capital. This process is known as a leveraged buyout. The key idea behind an LBO is to maximize the potential return on investment by using the target company's assets and cash flows as collateral for the debt used to finance the purchase. The process begins with the identification of a suitable target company that has stable cash flows, valuable assets, and growth potential. The acquiring firm then structures a transaction where a significant portion of the purchase price is financed through debt. This debt can come from various sources, including bank loans, high-yield bonds, or other credit facilities. The remaining portion of the purchase price is covered by the equity investment from the private equity firm or the financial sponsor. Once the acquisition is completed, the target company becomes a privately held entity or is taken private if it was publicly traded. The goal is to improve the company's operational efficiency, reduce costs, and implement strategic changes to increase its value. During this period, the company's cash flows are primarily used to service the debt, which includes interest payments and principal repayments. The private equity firm typically plans to hold the company for several years, often between 3 and 7, during which they work to enhance its value. This can involve restructuring the organization, expanding into new markets, or divesting non-core assets. The ultimate aim is to sell the company at a higher valuation than the purchase price, generating a profit for the investors. When the private equity firm decides to exit the investment, they may sell the company to another business, take it public through an initial public offering, or sell it to another private equity firm. The proceeds from the sale are used to pay off the remaining debt, with any excess representing the return on investment for the private equity firm and its investors. In summary, a leveraged buyout is a strategic acquisition method that leverages borrowed funds to acquire a company, with the goal of increasing its value and generating substantial returns upon exit. The success of an LBO depends on careful financial structuring, operational improvements, and market conditions that support a profitable sale or public offering.